Okay, good morning, everybody. It's 10:01. I'll call the February 8th meeting to order. Item number 2 on the agenda is to approve the minutes of the meeting of January 11th, 2018. I have a motion and a second on item 2. All in favor? Aye. All opposed? The motion carries. Item 3 is a consent docket. I have a motion and a second on item 3. All in favor? Aye. All opposed? Motion carries. Item 4 is the presentation by Rebecca Rhodes, Assistant Controller of the Comprehensive Annual Financial Report. Good morning.
Good morning. I don't do this very often, so I was hoping there was going to be a warm-up band, but at least you got cookies. So, but the ARS's annual financial had very good news. There were the auditors didn't identify any deficiencies in internal controls. We had no material weaknesses. We had what we call a clean opinion. So that was an unmodified opinion on the financial statements. So that's very good news. The financials themselves, the financial information is really presented in 3 areas. So I'm going to give you a very brief overview, but if you want to get more information and you want to know more, the management discussion analysis, which starts on page 13, gives you a lot of really good information about the details about what changed and why. The actual financial statements then read in connection with that, MD&A really put that together for you. And then and they start on page 17. And the notes to the financials, which start on page 19, give you very much in-depth detail of anything you might be interested in knowing about. So, but we're going to go very quick, brief, high level. So on the statement of fiduciary net position, which is equivalent in the rest of the world to a balance sheet, we reported cash investments increased by $58 million from 2016, and that was from increased investments of $77 million net of benefits and other expenses in excess of contributions of 19. So cash investments went up. I'm sure you have been hearing that from your investment consultants as well. On the statement of changes in fiduciary net position, which is equivalent in the real world to an income statement, the net income increased $77 million, and that was mainly due to market value appreciation. So good investment year. So as far as the pension plan itself, the net position for the system increased $53 million. So that would be like the fund balance, the equity, in other worlds, in other places. And that gave us a total net position of $702 million. The total pension liability increased $27 million to a total pension liability of $677 million. So the good news is we have a higher total net position than we do a net pension liability, which means that we have a pension asset of $25 million. As far as the funding of the actuarially determined contributions, we're 105% funded at this point, and that's kind of the old method of looking at pensions and where you stood, and I know everybody kind of is a little bit more comfortable with that, so I want to throw that out there for you too. So the good news is ERS continues to be on track and moving forward in the right direction. Any questions or?
Okay, well, thank you very much, Becky. All right.
Thank you, Jason.
The interpretation of the accounting language, investment language to accounting language is not as simple as that.
Absolutely.
Okay, next item is item 5 to ratify approvals. We'll approve those together. I have a motion and a second on item 5. All in favor? Aye. All opposed? Motion carries. Item 6 is to approve the claims docket. I have a motion and a second on item 6. All in favor? Aye. All opposed? Motion carries. On item 7, if you go to the not the very last case, but case 3266, we have a correction. The agenda currently shows option C was selected. That should be no option, and that'll be corrected in the minutes. So We have a motion on item, have a motion and a second on item 7. All in favor? All opposed? Motion carries. Item, oh, it looks like we've got 2 item 7s. Actually, item 8 is to, we have 1 case to receive the report of death and approve continuation of pension to the spouse. Have a motion and a second on item 8. All in favor? All opposed? Motion carries. Item,
Yes.
yes, ma'am, it will. Item number 9 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. We have 4 cases. Have a motion and a second on item 9. All in favor? All opposed? Motion carries. Item 10 is to receive the report of death, authorize the secretary to make necessary changes to conform on the following. 1 case. Have a motion, a second on item 10. All in favor? All opposed? Motion carries. Item 11 is, we have options here. We can have a presentation by Daniel Vallejo or his representative. We can enter into executive session with the municipal counselor to discuss the application of disability in the line of duty, and or item C, which there's a correction on item C. The correct case number, which will be reflected in the minutes, is 3572. Make note of that. So I don't see Mr. Vallejo present or a representative, so we would move to item B. Is that correct? And we'd have to have a motion to move to executive session. Have a motion and a second on item 11B. So we will go to executive session. We have to do a roll call vote.
Diana Berry. Craig Freeman.
Yes.
Carla Nichols. Dennis Spencer. Regina Story. Randy Thurman. Jim Williamson. Ken Culver. Paul Bronson.
Yes. We're going to go to executive session. C.
C.
Okay, we are back from executive session, and I will entertain a motion.
Make a motion that we deny the request for disability.
I have a motion and second on item 11C. All in favor? All opposed? Motion carries. Item 12 is items for individual consideration. Item A is a resolution approving a 5-year retroactive application of the pay adjustment granted to the administrator of the Oklahoma City Employee Retirement System on January 11th, 2018 for fiscal year 2017-18. Just to bring everybody up to speed, the administrative board met. As we discussed, for various reasons, Renee hadn't had an evaluation in 9 years. We all agreed that 5 years would be an agreeable level of retroactivity, and that's what we have presented here today. Going forward, we're going to do an analysis of some of the other pension system pay plans, and we will be bringing forth a recommendation on a revised pay plan for both the administrator and her assistant.
Mr. Chair, can I just add to that and just say that when the committee met, we all agreed that her performance during that period of time would have warranted an increase in salary, and that's the reason we made the decision that we did.
Okay.
So I move the item.
I have a motion on item 12A.
Second.
All in favor? All opposed? Motion carries. Item 12B is a transfer to the Long-Short Equity Allocation from K2 Overseas Fund to the K2 Mauna Kea Access Fund. Jason?
Good morning. So just to frame the discussion, we want to continue on the path of discussing alternative implementation options for the long-short equity strategy. We first had this discussion with you all, most of you, at the conference in September, talking about new vehicles that are available in the market, and specifically from K2. So today we want to take that to the next step. I don't necessarily think a decision to transfer needs to happen today, but we do want to get your sense if you want to continue to proceed forward, moving in this direction, because the next steps would be actually getting subscription documents and moving toward making that transition. So short of rehashing everything we talked about in September, we've put some of the same material here for you, really talking about what it is, what this Mauna Kea platform is. Short description would be it is a unmanaged fund of funds, meaning the managers that are available for investment go through the due diligence process of both K2 to get made available on the platform, as well as ACG. I have with me Tom Yanish, who's Director of Global Equity at ACG, and really has marshaled the efforts with helping identify K2 and this vehicle in the market. And he's going to talk more about how the portfolio would be constructed. So just as a reminder, if we turn to within tab 1, a slide on page 7 is intended to describe the differences. So when we invest in hedge funds, unlike traditional managers, it really necessitates building a portfolio of multiple underlying managers. Generally speaking, we'd like to see multiple of 10 or more. What a traditional fund of funds does is provide instant diversification. You're getting diversification across managers, generally, in this case, 20 to 30 underlying managers. The challenge of not using a fund of funds, which would be going direct to individual fund managers, obviously from an administrative standpoint, a decision-making standpoint, you're having to make commitments and review 20 or so underlying funds, legal counsel having to review subscriptions to multiple funds and make those decisions. So the fund of funds provides instant diversification and administrative efficiency. The evolution in the market, and this really evolved more in the wealth management space, the high end of the retail market, and has moved now, in our opinion, this K2 offering is really the only institutional quality offering in what we would call a platform provider. So it is effectively a fund of funds. However, the portfolio, the underlying investments are left to the investor to choose from the options that are available on the platform, which gives you the ability to customize the underlying allocation to a risk-return profile that is more consistent with what you're trying to do with that allocation. One of the things we showed in our analysis going back to say, well, first of all, does long-short make sense? And I think our analysis and to that determined, yes, it does. It provides a hedge against equity market volatility, provides protection in down markets. But from an implementation standpoint, we've probably got more protection, more insurance than we were desiring. The risk in a fund of funds, because it's so diversified, is less than what we're actually looking for. So the ability to build something that's not quite as expensive insurance may be more attractive. This allows, in our opinion, this allows you to do that. It's not one size fits all. So you are able to build a customized portfolio through the selection of underlying funds. The next page probably gives a better description of what's happening in a platform versus a traditional fund of funds and what isn't. So the things that have to happen to build a portfolio obviously is investment due diligence, operational review or operational background checks and things of that nature, the trading and administration of the fund, legal review of documents. An administrator or auditor is really only needed if it's a fund structure. You don't have that if it's not all wrapped up in a vehicle. So the direct, we say it's not applicable. And then portfolio construction. That portfolio construction is really the piece with a platform that is removed from the manager of the fund of funds. That's not being done. The investment due diligence, we say here with the overseas long short, that's what you're in today. K2 is doing all of the investment due diligence on underlying managers. Operational view, that's being 100% done by K2. Background checks, they outsource that to third-party providers. Legal review, they're outsourcing the legal review of the underlying fund documents that they're investing in to third-party law firms, as well as their in-house counsel, and the administrator and auditor, they're outsourcing that to have somebody do that. They're doing the portfolio construction. The access platform, the distinction, we say now that ACG and K2 advisors are doing investment due diligence. We've been able to work with K2 to establish that we're able to, through Tom's work and others at ACG, that are building direct portfolios for many of our clients, primarily our private clients. We're able to leverage that work with K2, and we're there then going in, not alongside, but independently, and underwriting certain funds to put on their platform. So ultimately, K2 is the fiduciary to that platform. No fund gets put on that platform without their stamp of approval, and it's the same level of due diligence and operational review, background checks, legal review that they're doing for their overseas fund. In addition, our team is very familiar, and we're doing full-on due diligence on these funds just like we would any other fund within your portfolio. Same with the operational side. The piece that's different, they're not constructing a portfolio. They're not then taking those funds that they've approved to be available on the platform and saying, okay, we're going to build a portfolio with these 15 managers, each one at 5% or 10%, and have a portfolio. That's not being done. The investor in the Mauna Kea platform has the choice. You get a single subscription document, and in that subscription document, it lists the funds that are available, and you check which funds that you wish to be in and in what percentage. And so that is what now comes to you that we would assist with, just like we do in any other strategy. The difference in that piece, which is a pretty big difference, you can see on page 9 from a fee standpoint, we're really driving fees and expenses down quite a bit. Currently, the fund of funds fee is 100 basis points management fee, and the operating expense, that's for all of these other things, background checks, legal review, administrator, auditor, that's 23 basis points. Those are generally fixed costs of a fund. It's not it just equates to 23 basis points, because that fund is larger, the percentage fee is smaller, and you'll see in the platform the operating expense is higher. As the assets in that Mauna Kea fund grow, that operating expense will go down because it's really a fixed cost. But the management fee is 20 basis points. So in terms of putting a portfolio together, there's an immediate savings of about $430,000. Now, it's a different portfolio. It's going to be a more concentrated portfolio. Currently, you have 32 managers in the K2 Overseas Fund. What we'd be looking at today is probably 10 to 15 managers. Initially, I think it's 10, and Tom will walk through that based on what's available on the platform. So
that would be 10 managers that we would select or that are available to select?
That are available to select, that you would then choose from those 10.
Okay.
And I think it's important to note, we have worked pretty closely with K2 to determine what managers we'd like to see on that platform, and we have the ability. It's going to continue to grow the number. It's not going to be 50. Tom can talk to that when he's talking about portfolio construction, and I think it'll probably be more like 15 to 20 that would be available to choose from. So still a very diversified set of options. Now that said, the opportunity set is really unlimited. We're starting from whatever's available in the marketplace and saying we'd like to see this fund on there if it meets your due diligence and vetting that you would perform on any other fund, and they go through that and they approve it, then it goes on there. So.
Had a continuing relationship that you would have with K2, that you had that ability to bring managers to the table?
Yes. It's not I wouldn't call it, we've just developed, it's a working relationship. There's no formal relationship other than the fact that right now, they have this access platform that is available to other investors, but there is a series within the platform that is only available to ACG clients today. We don't get paid anything more. We're not participating in the economics of this in any way. It's solely going to the benefit of our clients. Because I know that certainly could be a question here. We have the relationship continues to be with the client, the investor, and the K2 fund, and we're not getting anything back from that. So the benefits, page 10 just describes what happens, and we showed we use $70 million as the base because that's how much you have a 10% allocation to long short. That's right now you have about $72 million. I guess 10% would roughly be $76 million, so we're using $70 million just to do the math as far as the difference between the two, but then showing as we move out to the right that isn't the 100 and the 150 isn't necessarily you. It's as that Mauna Kea fund grows, the operating expense goes down because it's a fixed fee and you're just getting the benefits of scale. And we think they're certainly going to garner attention. We're talking about this to many of our clients that are in traditional fund of funds just because we believe it from a customization standpoint, from risk return, what you're trying to accomplish, we think it makes sense. From a cost standpoint, we think it makes a lot of sense as well. So the pros are pretty obvious. Fee savings, single subscription, it's administratively efficient, just like the fund of funds. Greater ability to customize the portfolio risk return profile. Cons, you have more decision points potentially to make. So If something goes wrong with underlying funds and we need to redeem, it's not just a redemption from the fund of funds. You would then have to make decisions if there's problems with the underlying funds. But we would be working with you just like we do on any other managers across your portfolio to address those issues. Potentially more concentrated, and we say lead to higher volatility, higher market participation. While this may be a con, we think it's really more the pro of the greater ability to customize. Our capital market assumption for long-short equity has always been, our expectation for long-short equity has been equity-like returns with about 60 to 70% of the risk of long-only equities. Really what we've been getting on the risk side is about 30 to 40% of the risk, and so that has put a ceiling on the upside. So it's been a little bit more expensive insurance, if you will. And it's hard to get what we're modeling in a off-the-shelf type of portfolio. Multiple K1s, I don't know that that's an issue. You still do get from the underlying, instead of a single K1 document from the fund of funds, you do get individual K1s from the underlying managers. I'm not sure that is an issue for you all as a tax-exempt entity, but it would be rolled up. You'd have a single NAV for the overall fund.
So right now we get, like in our report, we'll see it's K2 and we get the performance of the fund of funds.
Yes.
But since it's unmanaged,
we would still, it's just the allocation is unmanaged, but once it's put together, then it's managed by you, I guess. We would, from a reporting standpoint, it would look similar. You would see it, the best way to equate it, it's going to look like your private equity. You're going to have a line item for long-short equity for the Mauna Kea Fund of Funds, which is on the ASAP and in the quarterly report, and then rolled up statistics for the entire portfolio, which is when Tom goes through this, you'll see that. But you would need to see underlying manager performance because we are monitoring that as well. So with
we can provide additional reporting on that. And the only reason I'm asking is because if we're shifting it out of the responsibility of, where K2 is going to be managing that, is there more information that we need to receive periodically on the underlying managers?
Yeah, we would show
that we're doing our due diligence.
Yes, and we would provide that in our typical reporting package.
Okay.
So with that, I think maybe I'll turn it over to Tom to talk about kind of what a proposed portfolio would look like in terms of guidelines. Again, the next steps, if you were inclined to go down this path, I think would be creating policy, and I think, Regina, you brought this up when we talked in September. You do have policy today, guidelines for your long-short equity portfolio, but it's assuming that you're implementing through a off-the-shelf fund of funds. So that would need to be modified some. And what Tom's going to talk about today are some of those portfolio construction guidelines. I'll switch with you, Tom. So that would be the next step, and then reviewing documents potentially. So that I'll turn it over to Tom.
Good morning. So behind the second tab on page 10 is a picture of some of the parameters we use for portfolio construction. And we really try and think about this.
Page 15.
Oh, I'm sorry. My eyesight's bad. I apologize. Page 15. So page 15, you see the 4 boxes and the bubble chart up on top. And these are the different metrics that we think about when we build a portfolio. We're trying to diversify across multiple different things, across types of exposure, across regions of the world, across sectors of the market and market cap, and by idea generation. All these different areas we're trying to diversify the portfolio. So at the very top, just for definitional purposes, for equity long-short, the managers the difference between long-short and long-only, the long-only managers, you make investments with the hope that the stocks will go up. And that's a long investment. And a short investment for long-short managers, they make a short investment in the hopes the stock will go down. And so the term exposure, when a manager refers to their gross exposure, that's their long investments plus their short investments. And net exposure is your long investments minus your short investments, with the thought in an ideal world that your short investments hedge your long investments, and so your longs minus your shorts, your net exposure is your market exposure or your market risk that you're taking. So when we...
The simplest way to think of it is your long-only managers are 100% net long exposure. Your long-short portfolio today is below 100% net exposure to the market. And from this customization standpoint that I'm talking about, what we've seen, the net exposure has been lower, probably less than 50, which is more conservative than what we'd ideally like to see it be. So somewhere in that 60 to 70% net exposure is probably more optimal, at least for the cost for that insurance.
It's exactly right. Historically, fund-to-funds in general, as well as K2, the net exposure has been in the 30 to 40 net range. What we model in your asset allocation is about two-thirds, as Jason said, 60 to 70% is what we model in the asset allocation. That's why we think this could be a closer implementation matching the asset allocation work that we do. So across these four bubbles, these are four types of exposures that we think of. There's the low net exposure, which is 20 or less, the moderate, 20 to 60, and then the long biased. And in your global equity portfolio, your long-only managers, your small-cap manager would fall into that long bias bucket at 100% net long. And then the fourth bucket is the opportunistic, which we think of as somebody who will move up and down. They'll shift their exposure as they see opportunities in the market. So we've positioned these four different buckets and given target ranges for the weights of the allocations in each of the buckets, with the low net being 0 to 20. And these are the four squares that you see there. The moderate net exposure would be 30 to 70. That's going to be the majority of your exposure there, a moderate manager. The opportunistic net exposure, 10 to 40. Those are, again, the managers that shift back and forth. We don't want a whole portfolio of those, but it's nice to have a couple of managers who are a little more tactical. And then the long bias managers, who are in that 20 to 50% of the portfolio will be there, and these managers who typically are more than 80% exposed to the market. Those tend to be activist-type managers or just much more directional managers. So that's the first guideline we think of when we build the portfolio is the exposure buckets, and overall, we'll think about what the total exposure to the portfolio is, and we'll see that in a couple pages. So first we're thinking how much in each bucket, and then what the portfolio together is going to combine to. We also think, as Jason mentioned, about the number of funds. Studies have shown that the optimal number of managers is somewhere between 8 to 18. And these are different academic studies that have gone over the period of time to show, at what point do you lose the benefit of diversification and the benefit of that extra additional manager. So most of the portfolios that we've constructed for our clients have tended to be in the 10 to 15 range. We would expect probably, initially we're talking about 12 managers here. We'd expect it to be in that range. We put the guidelines of minimum of 8, maximum of 20. I wouldn't anticipate we'd approach either of those guidelines. The allocation per manager, a minimum of 5, maximum of 20. Again, anything below 5% doesn't move the needle. You probably wouldn't be. It's not to your best interest to make a small investment in a manager, doing all the work in the due diligence, and then having a small investment there doesn't help the portfolio. But at 20%, the size becomes too big, so you won't keep it in that size range. And as you'll see later on, most of these managers, we've sized them between 7 to 12%, so right in the middle of that band. The other area that we think about in terms of the managers is sort of core, satellite, and emerging, and that's the next line item there. A core manager is a manager that's typically globally diversified across regions of the world, across sectors of the market, diversified across market cap, just a well-diversified manager. That's a typical core manager that we would look at. A satellite manager is someone who's a little bit more specialized, a little bit more niche-y, might be a sector-specific manager, or it could be a manager who just does a certain strategy, event-driven manager who focuses on corporate events, or an activist who has a very concentrated portfolio and tries to get board seats. Those would be examples of satellite managers. And while the core managers will be 40 to 80%, the majority of your portfolio will be core managers. I think it's important to have some satellite managers because those are managers who really specialize in their areas. So that would be 20 to 60% of the portfolio. And then potentially we've left the ability to add up to 20% in an emerging manager. We don't currently anticipate allocating in an emerging manager right now, but we left that door open in the future. An emerging manager would be if you have a current manager that the PM spins out and starts their own shop, and it's a capacity-constrained environment, and you think it's a good idea to get in with this manager at his new firm before he closes capacity. That might be an example of an emerging manager. Or a manager who might have a longer track record but a smaller amount of assets. There's a certain element of risk to a smaller manager, so we think of that as an emerging manager also. Because there is this additional element of risk with an emerging manager, we would size them smaller, and in the portfolio we would only allow up to 20% allocation to those emerging managers. So this is sort of a picture of all the different parameters we've thought through in terms of diversifying the portfolio and building the portfolio for you. Before I move on, is there any questions on these?
So these would be proposed guidelines for you to incorporate into your policy if you were to go down this path.
In each of the buckets, it kind of lists, some of the proposed managers. And so if you flip the page to page 16, we've just put a thumbnail sketch of each of these managers.
So one of the, just to interrupt, I'm sorry, Tom. So one of the reasons why it took us from September till today to talk about this is we wanted to wait until K2 had populated the platform and gone through their due diligence and underwriting and put all of the funds on the platform. So all of these funds now are available on what's called the Mauna Kea platform.
And to your point, Craig, you had asked about other managers. There are other managers in the pipeline that will be added as we continue. Currently, there's 12 managers on here, and they anticipate going up to at least 15. Probably won't go much more than 15 in the long-short space. We will also, in the future, potentially add other managers for other areas. But for the equity long-short space, 15 to 20 is probably the maximum number of managers we would have, that K2 would have on the Mauna Kea platform. So you see the opportunistic, these two managers, are, as we've said, these are managers who will move their exposure up and down. We've limited the opportunistic to between 10 to 40% of the portfolio. Kingdon is a manager that has a 30-year track record. It's run by Mark Kingdon. He's the largest investor in the fund. And that's one of the other things we look at when we try and identify managers. We try and look at managers who have a lot of their own capital invested. So they're making money more so from the performance of the fund and less from the management fees that they take in. Their interests are aligned with investors, and they've got their skin in the game to feel the pain if the performance goes down. So Kingdon has been doing this for a long time. They operate with a macro element that overlays the fundamental portfolio. And I will say each of these managers that we go through here are fundamental stock-picking managers. There are no quantitative managers in here. There's no CTA managers, commodity or trading managers. So a lot of the market movement that you may have heard about related to quantitative managers would not be in this portfolio. These are stock-picking fundamental managers.
So just in the interest of time, I don't know how much you want to hear about each of the underlying managers. Tom can go through them, but I think maybe talking more about the overall, what the portfolio would look like. The other handout that we gave you that says the manager summaries, this is the full due diligence write-up on each of these managers. And I know we just handed it out this morning, so you haven't had time to go through it, but I think it's important for you to see this is what the level of due diligence that's happening, in addition to what K2 is doing. So unless you want to hear in detail each individual manager, maybe Tom, just go on to what the portfolio then looks like.
Sure. So page 16, 2 opportunistic. Page 17, there's 5 moderate net exposure managers. And you see some are core, some are satellite. Page 18, there's 4 long biased managers. And page 19 is when you put these portfolio parameters onto this list of managers, what this proposed portfolio would look like. So you'd have 47, and you're looking at, well, let's look at the first box, the low net exposure. Typically, we don't have a lot of exposure, and right now we're proposing 0 exposure in the low net exposure box. That low net exposure tends to be market neutral managers, often quantitative managers, and that's generally not an area that we've had a lot of emphasis in terms of recommending managers, because we want the total portfolio to be, as we mentioned, 2/3 of the market risk. It's not very often that we find a good manager who's a bottom-up stock picker that has a really low net exposure. I can think of maybe 1 or 2 in the 18 or 19 years I've been doing this that we've identified in that space. The moderate net exposure, based on this lineup we propose, would be 47% of the portfolio. So right in the middle of that 30 to 70 guideline. Opportunistic net exposure would be 21%, and long bias would be 32%. The number of managers would be 12, and the size range of those managers would be from 7% to 12%. The 7% being the satellite managers, and the 12% being the core managers. And then the allocation across that core, satellite, and emerging, with this proposed portfolio, there would be 53% in core, 47% in satellite, and 0 in emerging currently. If you go to page 20.
Tom?
Yes.
Excuse me. So
sure.
if, with this allocation, what's the net market exposure then?
That's on the next page.
Okay.
Thank you for setting me up. So this is the way we look at it internally. We collect this information on a monthly basis from the managers, and we roll it up at the portfolio level to try and track both the managers as well as the total portfolio. So as you see, there's page 20, there's 3 sections. There's the total exposure, and I'm going to go from left to right in these columns. The total exposure is long, short, gross, and net. So that net column you can run down and see, and this is at the end of December, the net exposure for each of the managers, and the number you want to look at is in gray at the bottom, that's 70%. So the total net exposure of this proposed portfolio would be 70%. Now the managers themselves move that exposure as they see fit. ACG doesn't control that exposure. The managers control that exposure based on their opportunity set and where they see the market. But historically, these managers have stayed within a range, and that's why we've selected them. And they've been in those ranges that we talked about earlier. Other than Kingdon and White Elm, they will move more dramatically, but the other managers stay in a tighter bound range. So if you looked at historically, this collection of managers probably would have been in a 60 to 70 net range over the past couple years. The next section is the regional allocation, and this looks across different regions of the world, and we compare it to the MSCI Equity, which is the global index, to see where you would be overweight or underweight. And this is one of the benefits of being able to customize it, because we also know in your long-only portfolio, you've got Wells and Wasatch, who we think highly of and are doing a good job, and they're covering the emerging market space for you. And especially in the coming market where we're really optimistic about emerging markets, we think it's probably better to be long-only than to be long-short in the emerging market space. So when you see under Asia, your portfolio would have 6% exposure in Asia, and then if you go down, that's a 15% underweight to the global index. we're not concerned about that because we also incorporate the knowledge of Wells and Wasatch in the portfolio, and they're already doing long-only emerging markets for you. And again, that's sort of the benefit of being able to customize this. And the only other number that jumps out there in terms of the relative to the index is the market cap. And we're slightly underweight the large cap, and that's because we've got investments in mid cap and small cap. And the one thing that you need to remember in the global long only, the MSCI World Index doesn't have small cap in it. So it's just a large cap index. So any investment you make, and we believe you should be invested across large, mid, and small cap, be diversified across market cap. So any investment you make is different from the index, and that's the only reason that those weights are dramatically different.
That's indicative of any active management. With active management, whether it be long, short, or long only, you're going to have a higher weighting to mid and small cap because it's more inefficient than large cap relative to indices.
Page 21 is the same view, but this time we're looking across sectors. And you see, again, down in the gray, this is the roll-up of your portfolio, diversified across all the sectors of the market. And the only sector in which you're underweight is financials, and we don't have any heartburn about that. Financials have been a really difficult spot for a number of years now. And we do have managers who invest in financials. If you look up above, you'll see some managers with financials exposure. If the financials opportunity improved, those managers could increase their exposure and take advantage of it.
So really, this is examples of kind of rolled up reporting that we'd be able to see. This is a fallout of what the manager's exposure is at the end of the period. You're not going to be able to control this, although we are able to look at it and make recommendations based on, well, we say we want to be diversified, and either we are or we aren't. And if we're not, we can make changes at a manager standpoint.
So the management of this going forward, though, would be like, you're looking at this detail level because really you're facilitating us manage it.
Yes.
If you see someone that's going away from what we want in the portfolio, you may recommend within the fund of funds that we drop a manager and add another manager, any changes along the way.
And I could see it being more, dropping a manager may be more because there's a problem with that manager. But if things start getting out of whack from an allocation standpoint, it may be we need to reweight within the manager, the existing managers. So move from AKO at 10%, they're up to now 15. We need to trim that back to 10 and reallocate that.
Where normally we buy a fund of funds, and we're in the fund of funds.
And they're doing all those things are happening. You're just not aware of it. So it does. There is some more decisions that have to be made. I don't want to make it sound like it's very active and a ton more decisions, but there are more decisions. That's the delta between the $800,000 and the $400,000, or the $400,000 delta in cost. There are more decisions that are being made by you with our advice.
Page 23 is a good picture of the performance, and again, this is performance. If you had had these managers in hindsight, what would they have done?
That's the other, so this, and I want to be careful here. This is how we look at when we roll up managers together and we show you what a combination of managers would have done historically. This is hypothetical performance. It's not a composite that existed. It is these managers in these weights that we're suggesting today had they been in place historically. And so that's perfect hindsight. So I think what really, the statistics that I think matter here are the risk statistics and the distribution of outcomes. Does this look a little bit more like what we'd like to see from an asset allocation standpoint? So Tom, you can walk through some of that.
I think that's the important.
Tom,
yes.
I'm sorry.
Oh, you're fine. Love the questions.
The fee savings,
yes,
are they built into this table?
They are. This is net of all expenses.
So the platform we added, because the platform fees would not have been included in the underlying managers, but we added on a monthly basis what those fees would be, and it was at 60 basis points, right?
Yes.
Across all time periods.
And then the K2 would be that it's net of fee, it's reported net of fees anyway.
Yes. That's exactly right.
Net of fees. So we've added additional layer of fees to what this platform would be to make it as best apples to apples as we can. And it all includes the underlying manager fees are all in there as well.
So on page 23, it's a good visual because we always talk about the equity long-short asset class as trimming the tails. You're giving up the right side, but you're also not having the downside of the left side. And so you see the market index is the green bars that has the far tails on the right side and the left side. You see your current K2 is the dark blue, which is very tight in the middle, and then you see the proposed platform. You have the opportunity for more upside. There's more in the 2% to 4%, and there's more in the 4 to 6%, but you also see a little more potential for downside. So we're widening the range of outcomes, but not nearly as wide as the global index. Still protecting on the downside, but hopefully achieving more on the upside. And you can look up on page 22, again, this is the roll-up of what the portfolio would have done if you had had these investments. And I'd like to look, the one number I think to focus on, you can look at return, you can look at standard deviation with the volatility, but the Sharpe ratio is always important to me, which is just a risk-adjusted return. And you see for the proposed portfolio over 3, 5, and 10 years over long periods, it's a strong risk-adjusted return. So there is slightly higher volatility, as we mentioned, slightly more volatile than the K2 portfolio, but you're paid for it, you're compensated for it because your risk-adjusted return is higher. And then as Jason alluded to, if you go down to the very bottom, on the far right on the bottom is the up capture and down capture. Over 10 years, you look at the up capture goes up, the down capture goes up slightly as well, but not nearly as much as the up capture increases. So hopefully you're going to be able to capture more of the upside and still protect on the downside.
So ultimately, we think this is a good idea. That's why we're out here talking to clients about it. We think there's fee savings. We think the customization is beneficial to you. There is a little bit more work. We feel that we're doing that work to begin with. We're looking at these managers. We're able to leverage what we're already doing to the benefit of our clients. So like I said, the next steps would be for you to determine, is this a direction you want to go? And if so, we would have K2 provide the subscription documents for Wiley to review. They're not that different than the current ones, except that you then pick the underlying allocations. We would then work on creating guidelines consistent with what we've proposed here, as well as a implementation schedule, because the getting out of your current investment requires some notice and time to get out of the current investment with K2, probably a quarter or two to get completely out, if that was the direction you wanted to go.
So Jason, would our total allocation as far as the total portfolio stay the same?
Yeah, we're not suggesting any change to your asset allocation. It's still a 10% target to long-short equity.
Okay.
It's just how you're implementing the long-short equity. The vehicle is really, think of it, nothing's changing to the asset allocation. You're changing from one vehicle that is 100% managed where you don't have to do anything other than decide to be in it, to another vehicle that is, you have to make some decisions as to the underlying allocations within it. Yeah.
Does anybody have any questions? Okay. We have to take action on this, correct? And B?
I think he's going to bring back documents. for
Yeah, I guess
approval.
we'd like your,
That's okay.
just the input
Right.
is, yeah, is this something that you want to pursue, or that we want to pursue this, or no?
Right.
Just,
I think this presentation has been absolutely excellent, and I would like to pursue this.
Is that a motion?
If we need one, that is a motion.
We need one.
I move it.
Have a motion and a second on item 12B. All in favor? Aye. All opposed? Motion carries. Item 13 is the investment consultant report.
so you're going to hear more from me.
Yay.
I'm just going to talk about the ASAP. So much as, it seems like a lot has changed since the end of the year, certainly over the last 4 days. That said, I just wrote some numbers down before I walked in this morning, and it's shocking. Your January return for the total fund was a little over 3%. So if you extrapolate that out over 12 months, that's a 36% return for the year. Clearly, that's not going to happen, right? So now as we sit here today after what appeared to be a lot of volatility and carnage in the markets, the S&P, as of this morning, was positive 44 basis points year to date. Russell 2000 was down 1.74 year to date. The EFI, or International, was down 34 basis points year to date. And emerging markets were up 1.3% year to date. Bonds, the Barclays Ag was down 1.82%, so that's the biggest decline, even more than small cap. So we certainly have seen pretty significant volatility and declines, which should not be unexpected. We've really seen some unprecedented growth in valuations. As we came into the end of the year, our opinion is valuations are stretched across asset classes. Everything was expensive. Nothing was really attractive. Some things a little bit more attractive on a relative valuation basis. We continue to believe, as Tom mentioned, that emerging markets and international are a bit more attractive than U.S. stocks, and that stocks are more attractive than bonds. I suppose that shorter-term bonds and even cash is becoming more attractive. I saw our first, we do what we call a relative asset class valuation ranking every quarter, and it's a 1-year outlook on asset classes relative to our capital market assumption. So do we think that asset class over the next year is going to achieve our intermediate term or 10-year capital market assumption above or below? And for the first time in, I'd say, 10 years, cash is not negative, it's neutral. So we've been negative on cash for 10 years, and now we're neutral just because rates have come up a bit. That's not to say as a long-term investor we're recommending you moving to cash, but it's just showing how much rates have moved. The 10-year Treasury, I was looking at this yesterday in a quarter report, in calendar year 2017, 10-year Treasuries moved 8 basis points. They moved from 247, I think, to 241. It moved up 8 basis points. Hardly any move. But since the end, but there was a big move down and then a big move up during the year. Since the end of the year, in the 39 days since the end of the year, the 10 years up to about 288, 287 something this morning. So about a 46 basis point move, which is a pretty steep move, certainly in yields, which has spooked the markets. I think we think concerns over rising rates and then potentially the Fed having to move faster than expected has spooked the markets over the recent days. But we've gone through a period of unprecedented low volatility. And so when you have days like this, it's certainly surprising, shocking, you feel like you want to react, but as we always say, our message is, this is short-term. We want to stick with the long-term plan, which you all have done. The most important thing we think investors need to continue to be cognizant of is this avoidance of complacency and being disciplined and rebalancing and taking down risk where necessary, and you've certainly done that. So as we look at the end of January, overweight to equities about 3.8%. I'm sure that's moved a little bit in the last week, but bonds are down slightly as well, so it's probably balanced out. Real assets are continue to be underweight by about 3%. Total fund on a one-year basis through the end of January was up, and this is on the second page of the ASAP, up 17.6%, 17% on a net basis, which is ahead of your policy index, well ahead of your required return. Really, every asset class has been additive. If we look on page 2 of the ASAP, your large cap, roughly in line with the S&P, adding about 7 basis points. Small cap, really good returns from your small cap portfolio. Times Square and Earnest. Times Square is SMID growth. Growth outperformed value by quite a bit over the last year. I think I mentioned this last month. Earnest, more of a relative value manager that does have some in their construction parameters. They do have a momentum factor that tends to make them a little bit more growthier, and so they've really outperformed the value benchmark this year, so they've been the most additive. Times Square actually lagged the growth benchmark a bit. They were up 25% on the year, and the benchmark was up 27%. The day before yesterday, they did announce a change at the analyst level. They've let go their healthcare analyst. Our small cap analyst, Kat McGrath, was in their office last quarter, and she'd been pressing them for about a year on their performance, and really that healthcare had been a tough area for them. They'd been underperforming primarily in healthcare. Certainly not as a result of Kat's pressing them, but they had decided to let go of that analyst and replace that individual with a new person, somebody else on their team. So I think it's a positive change. Nothing's changed with respect to the firm overall and the lead PMs there and their philosophy and strategy, but it's good to see them taking action. Other strategies, the international, you can see the international composite had done very well. This is your developed markets, Harding, Loevner, and Lazard, up 38% for the year, so one of your best performing asset classes versus the benchmark, I'm sorry, up 32% versus the benchmark up 28%. Emerging markets were up 38%, which emerging markets was the best performing asset class. Your emerging markets overall lagged the benchmark at 41. Again, we're not at all concerned when we're up 38, benchmark's up 41. The Wells Berkeley Street is a bit of has a high quality component to it. They will lag when markets are up that significantly. It's kind of a similar story to what we've said across the board in your portfolio. And then finally, fixed income, nice, very good relative returns within fixed income, up almost 7.5% versus the ag up 2%. Your fixed income is very diversified with the Core Plus and the global bonds with Brandywine, as well as the PAMCO absolute return hedge fund piece, all being additive. That said, we are wanting, this is another area where we want to be careful that we look at relative weightings within the portfolio and not letting the areas we've built fixed income portfolios to have more flexibility with managers that can be in high yield, non-U.S. bonds. The spread, particularly for high yield and lower quality credit, is pretty narrow today. So we want to be careful that we're not letting that just run up too much. Now, within your portfolio, Western, they have the ability to toggle back and forth as well. They can bring that high yield and lower quality credit exposure down, which they are doing, and we're being mindful of watching that to make sure that we don't need to make any changes at the allocation level within fixed income, moving toward some of the higher quality areas. But overall, that did very well. And then finally, real estate did well. Your overall real assets up over almost 9%. Big contributions from the real estate, and actually from commodities. Over the 1 year, commodities were up 7% on the year, so performing well. Again, portfolio performance very strong. We don't expect 17% a year returns. That's not realistic. Going forward, we're comfortable with your asset allocation implementation. At this point, no manager issues or concerns to take action on. The last thing I need to mention, I know I did this last year, and I feel like boy who cried wolf, because we kept talking about the trustee education session that didn't happen last year. It is booked, and it's happening on, I think Renee said something out, Thursday, April 12th at Devon Tower from 11 to 1. We're hosting a client educational forum, so hopefully you all got that information. I think we'll have a couple of speakers, and we'll have lunch and hopefully get you in and out in a couple hours. Okay?
Anybody have any questions for Jason? Thank you, sir.
Thank you.
Item number 14 is comments from board, staff, and citizens. Hearing none, we are adjourned at 11:14. Thank you, everybody.